see that okay?
Yep.
Right on. Okay.
We don't have to unmute to tell you that we see it fine.
Or you can just throw the thumbs up in the air. That works too. But thanks, Steve. So I'm really excited about the conversation we're going to have today. One of the things that Nick on our team pointed out, which is this is absolutely like the month that was exactly a year ago, where we all kind of had to hunker down. It was actually a year ago today. I had to make the decision not to go to a Warriors-Raptors game. So it was my first COVID canceled event. And it was the first month that we did a resilience. So this is our 12th resilience call, and kind of hanging out with you guys this way, and really thrilled about the year that we've had and optimistic about what is ahead of us. And I know it still feels like we're in the muck. But this call is going to be a little bit about getting out of the muck and starting to accelerate. So we're going to talk about two things in particular. One, Adrian Rawlinson, who's actually not only an investor in the fund and a guru, as you guys know, also a medical doc, is actually giving vaccinations to folks and is coming to us live from a vaccination site. So he's a very capable, and that British baritone is going to give us a little bit of his thoughts on where we are in COVID. But then we're going to shift gears and talk about this thing called SPACs. And for those that are deeply involved in those things called SPACs, forgive us a little bit of the upfront, but Steve Fletcher, who's also a guru and investor in the fund, who's been very successful in raising 5. Bruce Linton, who's also a guru and investor in the fund, has raised 2. I think between them, they've raised almost $1 billion in the last 12 months while we were all stepping through COVID. So talk a little bit about what's going on in the world of SPACs, and as it relates to that is sort of financing alternatives. Jason Costi, former CFO at Casper, is and also a guru and investor in the fund, is going to talk to us a little bit about alternative financing for growth in the D2C space, which is sort of addition to sort of the SPAC conversation. So that's what we're going to chat about. I'm going to start a little bit with sort of our outlook. So I think in our last conversation we said, it looks like Q1 and Q2 is going to be bumpy. I think it's going to continue to be bumpy, but on the positive side, we think we're getting a much better outlook on where COVID's going and sort of where the economy follows from that. I'll let Adrian give you his point of view, but could we be at effective herd immunity between those that have had COVID and got vaccine by Q3? Fingers crossed. Capital markets look robust, even though a little bit bumpy right now. The taps are wide open from a monetary and fiscal point of view, and there's capacity in the economy. So we think things are actually looking pretty positive, for the back half of the year. So maybe not quite the roaring 20s, but pretty close. And there's still some uncoupling between Main Street and Tech Street we've talked about. We still think it's really important to have this eye on 18 months of runway for our founders and managing that as a key metric. But I did have a picture of somebody who had their foot partially on the brake and partially on the accelerator. I purposely took that off and added the pedal to the metal with the accelerator down, because I think one of the things that we all need to be thoughtful about, having been through this for the last 12 months, is you kind of get into a COVID way of doing things, and I think it's about to change. So challenging your assumptions about what's in front of us, I think it's an important thing to do, and thus the change in the image. So with that, I'm going to hand it over to Adrian, and we're going to flash through these slides very quickly to get into the SPAC conversation with Steve. But Adrian, you want to give some of your thoughts live from the Marin Center, jabbing people with needles?
I hope you can hear me through this mask okay. I'm not really supposed to take it off, so I better keep it on.
Yeah,
so
perfect.
Great. Thanks, everybody, for joining the call. I won't keep you long. I actually just volunteered, my first day volunteering today, with about 1,000 people coming through here today. It's a pretty slick organization here. It's impressive with all these volunteers. And a lot of questions about the vaccine and Moderna and Pfizer and J&J and all that sort of stuff is coming through the door. So we're doing a lot of educating and reassuring and stuff. So I just wanted to, the slide deck essentially is really for you to take away. It's some very simple information about vaccines, about how to get the information across about vaccines. There's a lot of misinformation out there on social media about all sorts of weird stuff that's being thrown around. So take a, digest the slide deck in your own time, and feel free to share it with friends, with relatives, with staff. If you take care of a large organization with a group of employees, please feel free to to pass it on. As I say, it's basic information about the pros and cons of vaccine, how safe is the vaccine, what are the side effects, what is the difference between Pfizer and Moderna, and more recently, what is the advantage of the J&J single shot, which in my view it's a development, the single shot. And if you look at the data, I think everybody will be continually impressed by the efficacy of the single shot. What you have to realize is that J&J is a different vaccine to Pfizer and Moderna. It's built differently, it acts differently, it stimulates the immune response in a different way. And also the studies that were done on J&J were done basically with the incidence of a lot of variants, whereas the Pfizer and Moderna trials were done on a relatively free population without variants. So you can't really compare the two. However, what I will say is that some of the data that's coming out about J&J shows that your actual immune response is still increasing after 30 days following the shot, which is kind of interesting. A lot of people say, shall I get Pfizer? Shall I get Moderna? I think there's absolutely no difference between those two, to be honest, as regards side effects. Some people who have allergies maybe prefer to have Pfizer, but there is really no difference. These vaccines are extremely safe. They were tested on a large group of people. And I feel confident recommending it to virtually everyone. There's hardly any contraindications to the vaccine. With that, I'm going to have to sign off in a minute because I have to go back inside. But have a read of the information. Please feel free to reach out to me if you have any questions. Yes, you still need to wear a mask after you've been vaccinated, unfortunately. As regards Chris's question about herd immunity, I think there's a distinct possibility that we could reach a very significant, penetrance rate. Maybe the end of the summer, July, August time. I think there's a good chance we can start to, really think about the significance of what herd immunity means and where we are in that scenario. Certainly by the end of the summer, I can see a lot of relaxation of some of the guidelines that are out now. And hopefully we can get back to some form of normality. But that's kind of I just wanted to present that in a nutshell. Really, I wasn't really planning to go through every single slide one by one. So think about having the vaccine if you haven't already had it. Spread the word to your friends, relatives, neighbors, employees. Let's get this thing behind us. And as I would like to conclude, this is a team sport. It's not an individual thing. Having a vaccine, not only provides protection for you, but you're on that, you're part of that team approach to herd immunity. So with that, I will pass it back to Chris. Thanks a lot, guys.
Adrian, thank you so much, bud, for taking the time. And
No worries.
you've also had the vaccine yourself, right? So
I had Moderna. Yeah.
Right on. So live to tell the tale, as I think increasingly, hopefully, more and more of us will have.
Out for about 24 hours after the second shot. It makes you a little bit groggy for 24 hours, but it's a small price to pay.
Awesome, Adrian. Stay safe, buddy. Thank you again for everything you do.
All right. Take care, guys.
All right. With that, Mr. Fletcher, tell us about what this SPAC thing is and what does the acronym actually mean?
Yeah, thanks, Chris. Appreciate that. I will do that, and hopefully I will try and keep it as pithy and interesting as Adrian just did. So SPAC is a special purpose acquisition company or special purpose acquisition corporation. And think of a SPAC as an alternative way to get a company public. And so you hear a lot of news about SPACs. Is there enough disclosure? Is there enough diligence? What's going on? Are these things bad? Is everybody getting rich? The reason that I started this company Explorer 3 years ago was two reasons. One, we saw that there were more and better tech companies now than ever before, and I think many of you are evidence of that. Obviously more money going into venture, more money going into private equity tech than ever before. But strangely, fewer exit opportunities for those tech companies, right? Fewer M&A exit opportunities, and more importantly, fewer IPO opportunities. Whereas in the 1990s, there were hundreds of tech IPOs a year. In the last 3-4 years, we've been down to about 24 tech IPOs a year. And so we said, there really needs to be an alternative way to get these great technology companies public, and we thought that SPACs would be a great way to do it. Little did we know 3 years ago when we started this that everybody on the planet would 24 months later come to the same conclusion. But clearly SPACs have really exploded as a way to get technology companies public, and I actually believe and we'll go through some of this, it's a quicker, more effective, and less dilutive way to get companies public. So let's keep going, Chris.
Yeah, and then just before we jump in, so I think just to kind of calibrate for everyone, we're going to have 15 minutes where Steve's going to do SPACs 101 to kind of get us, onto the same page, and then we'll go into Q&A. But if you've got questions in the interim, just throw them in the chat. You can see that little double bubble in the bottom right, and we'll try to get to those questions too. So with that, back to you, Steve, and
perfect.
We'll go into what's going on with SPACs.
All right. So next page. There we go. So as I say, SPACs have exploded, and I sent this deck to Merrill and to Chris 2 weeks ago, and it's woefully out of date 2 weeks later, right? So 3 years ago when we started this, there were 36 SPAC IPOs in 17, 46 SPAC IPOs in 18, and then 56 SPAC IPOs in 19. And then you go from, just a sort of stair step to 20 SPAC IPOs in 2020. And there's been about 100 SPAC IPOs in each of January and February. So SPAC IPOs are now about 80% of the US IPO volume, which ultimately means a huge number of newly created public companies, because SPACs are just a vehicle to get other companies public. But this is really an explosion that you haven't seen in many years as a way for companies to be going public. As I said, 2 to 3 dozen tech IPOs a year for the last 3 or 4 years. Many of these SPACs now are focused on tech, and so you're going to see many more companies going public. And to the point that this has become mainstream, the companies in the middle may not be well-known names, but Opendoor and Skills and SoFi and Shift and AvePoint, these are middle of the fairway venture capital companies. And then on the bottom, you've got companies that are owned by big private equity firms who are also selling their companies to SPACs. So we'll in the interest of time, Chris, we'll keep going. But this is now clearly a very mainstream alternative. Bill Gurley, who's been a very outspoken critic of the IPO process, says with IPOs being so blatantly underpriced, SPACs are now clearly the cheaper alternative. And that was last year. Not only is it cheaper, it's also completely middle of the fairway now, where no company should be thinking, well, I'm super high quality, I shouldn't go public through a SPAC. I would say it's now better, faster, cheaper to go public through a SPAC. Obviously, I'm biased, but that's my view.
I think, I don't know that whether you're taking into account what a great deal this is for the sponsors and how the hedge funds are being sponsors. They're buying stock at $1.50 that then sold to the public at $10. So, the amount, these are the people who are virtually guaranteed a 5 or 10-fold return. So the hedge funds are doing this. So at some point, the SEC might think that's not such a great deal for the investors who come in and buy these companies on merger. They come in, they pay the $10, they get a chance to approve the merger, but whether they make money or not, the sponsors make out. I mean, how can they lose? Their cost basis is like $2 a share for shares that are starting off at $10. So I think there is a negative side here. So
yeah, it's not a perfect structure, but I would say, well, as a sponsor, I will say, one, when you think about a venture or private equity firm, those firms in general, the sponsors do not need to put upfront a lot of capital to get the firm started. Doesn't mean they don't, but they don't need to. And in the case of SPACs, you actually do need to put up, many millions of dollars as a sponsor. There is a good payout for it, but that's very, very fully disclosed in the documentation. I think, and everything I've heard about the SEC is that it's really about disclosure. Ultimately, investors can make their own decisions as to what they want to do. There certainly could be more disclosure required for the SEC, but I don't think the SEC is going to step in and say, no, this is a bad idea. I think what they may do is say, you need to disclose more about X, Y, and Z.
So Steve and Bob, can I ask, Bob, do you mind if we just hold that question? Because I'm just trying to get everyone baselined on what a SPAC is and how it works. For those of you that don't know, Bob Posen, who's also a guru investor in the fund and also the former chairman of the advisory board to the SEC. So we've got a pretty amazing community around us to kind of go through this. But Bob, can we hold that question just for a couple minutes and let Steve get through a couple more slides? And I'd love to come back to it in terms of the pros and cons of this approach versus other financing options.
Thanks, Chris. So yeah, why is a SPAC what are the advantages of it? Why is it a better way, in my opinion, to go public? Four real key attributes. One is it's faster and higher likelihood. These are not going to be 100% certain from the time a deal is announced to getting public. But once a SPAC deal is announced, now they're almost always announced with a PIPE with them, which means you've already got real investor sponsorship from people who've done real diligence. And ultimately, historically, the likelihood of publicly filing an IPO S1 and getting that closed is lower than the likelihood of completing a SPAC transaction. So it's much faster, typically 4 to 5 months instead of 12 to 18 months of prep for an IPO with higher likelihood. Two, there actually is more comprehensive marketing. And so to the point earlier that investors are holding the bag, there is something to that. But the reality is these are companies that are having public disclosure requirements for effectively 2 to 3 months from announcement until closing. as opposed to a very, very lightning fast IPO roadshow. So there's a lot more marketing and disclosure for the companies, and they can disclose more to the street because it's a merger rather than an IPO. There's a lot of flexibility to it. You can have an earnout. You can have pipes, you can have primary, you can have secondary, you can twist a whole bunch of knobs and dials, as opposed to an IPO where it's basically number of shares and price per share. The public market sponsorship is there. You do get the exact same investors on a SPAC as you do on a traditional IPO. And then really importantly, for many of the SPACs, certainly not all, but the thing that I think is really positive is that the SPAC sponsors are in for the long term. They're locked up for a minimum of 6 months and often longer. And typically the SPAC sponsors go on the board and are very experienced folks to really help the newly public company achieve success in the public markets. So let's go next page. All right. So why do the public markets like SPACs?
A little bit.
Yeah, that's fine. So public markets like it. They can build real positions. There's a dearth of small cap companies, and they get to know the teams. And then I guess in the interest of time, what have I done? So as I said, we started the business 3 years ago to help more companies get liquidity because we just thought there was not enough liquidity for tech companies in the market. And we've listed 5 SPAC IPOs, 2 of which have announced mergers. And we think we're really creating a lot of liquidity in the ecosystem and really help companies go public and importantly help executives execute SPACs in a much more professional manner. So I'll stop there, Chris.
Yeah, I think it might be actually useful, Steve, if you can just talk about this slide a little bit, as it relates to our founders, what is, because there's as many flavors of SPACs as there are 31 Baskin-Robbins flavors. So just, how your motion is different and how to think about things.
Good question. Thank you. So, what we try to do very differently than many other SPACs, particularly ones that are sponsored by former private equity guys. My firm, Explorer, partners for every transaction with former public company CEOs to execute our SPACs, and those CEOs then go on the board and really help the partner company management team thrive as a public company. And so ultimately, what we want to do is not just a transaction to get a company public, but we want to have a long-term partnership to get the company to thrive post-transaction. And so our teams work with them on product, on sales and marketing, on strategy, on working with the street, to really improve the operations of the business, because ultimately we are not about so-called pump and dump. We are about long-term partnership and creating long-term winning companies. And that's what I think is really one of the key things for all of you gurus to think about as if you do end up going the SPAC route, how do you want to do this? There is a negotiation with the SPAC over what's the valuation of my company and how much money are you guys getting and everything else. The reality is, while those are important, this is an IPO, and we're going to, most SPAC sponsors are going to price it at much lower dilution than a traditional IPO. And the key is, who's the right partner for you? Because these are folks that are going to be on your board and going to be helping you succeed as a public company. And that's what you really want to pick, is who's the right partner. And then once you pick the right partner, then you figure out, how do we get the right terms? Chris, I think you may be on mute.
Yeah. Steve, you want to just touch briefly on these two examples, and then we can come back to Bob's question, which I thought was excellent.
Yeah. So this was our first SPAC. As I say, we always partner with public company CEOs. So our partners here were Lloyd Carney. Lloyd was the CEO of Brocade, which he sold to Broadcom for $6.5 billion before joining us. He's also on the board of Visa, chairman of the board of Nuance, and other companies. And then Eric Benamou, who was the CEO of 3Com and Palm. So these are very seasoned executives and board members who really are deeply experienced at running a public company. We partnered with a digital transformation company called Grid Dynamics and closed it literally just before COVID really hit hard in the US. We closed it March 5th. And then
so Steve, just backing up so that those of us that are not sort of in the middle of the SPAC universe. So basically what happened was you set up this vehicle called Surge, and you got these two guys to join you. And then you took that to the public markets and raised the cash. And then with these two guys, you guys went to go find a company to go partner with. So basically, like our founders, private companies with great acceleration that could be a good public company. And it was Grid Dynamics was the company, and then that got acquired by the SPAC, and now
merged with the SPAC. But yeah, Chris, everything you just said is correct. I guess what I was going to say is that the critical point to that is to my point on partner first. This is a company that got really smacked by the market downturn in COVID, and these two guys were very active and really helped the management team turn the company around. So it really is about partners and who you pick. But Chris, your description of the steps is exactly right. A SPAC raises money in the public markets, goes to find a high quality private company, merges the SPAC with that private company. The private company merges into the SPAC and becomes a public company in that process. We did the exact same thing with Apex. We partnered with Jeff Epstein, who was the former CFO of Oracle, and with Brad Koenig, who was the head of tech banking at Goldman for 15 years. We went out and raised $350 million in the public markets. We merged with a company called AvePoint, which is a high growth SaaS company, data management business. We valued the company at $2 billion. And when that closes, AvePoint will merge into Apex and become a public company.
And I'm just going to jump through the last couple examples. So Steve, you've got three others that are in process.
We have three others that are public now, where we've raised money in the public markets. We've raised, for two of them, we've raised $400 million each, and from one of them, 600. We've got a fantastic set of teams who are all very seasoned public company executives looking to partner with great private companies.
Awesome. And then do you want to go back to Bob's question?
Chris,
Bob, you want to reframe?
Chris, no, let me be clear. I think it's a great deal for the companies involved. I'm just saying what happens is the sponsors put up capital, that's correct, and they essentially buy an option, which if they don't merge in 2 years, they'll have given up their premium. But so far, all these SPACs have merged, have acquired. I think from the point of view of your companies, Chris, the one you're involved with, it is a very good deal for them because they have a lot more certainty in the process. They're able to use projections of future revenue and earnings much more than you would be able to in an IPO. And because you sort of know pretty much who are going to be your partners, to the extent that, I mean, most of these SPACs, it's essentially a blank check sort of thing. They're now anywhere between 100 million and $1 billion. usually the SPAC, these days there are so many SPACs out there, 300 or so, that most of the SPACs that are coming out have a tentative handshake sort of deal with a merger partner. I mean, you wouldn't really want to have a SPAC unless you had some idea of 2 or 3 companies that you thought were likely mergers, partners. And then you can get experienced executives to work with you. So I think from the point of view of the private companies, it's really good. There's nothing negative about it. It's all positive. And if the SEC has more disclosure, it won't make a difference because investors will buy these things if they think the deals are good. And there is one protection for people who put up the $10 is if they don't like the merger, they can redeem their shares at roughly $10 a share. So if they don't like it, they can leave. And so I don't think it's got a lot of liability involved. I think the key thing is, as the speaker has said, is to find the right set merger partners. And these days, you don't just merge into the SPAC, you raise capital at the same time. You may have 2 companies merging into the SPAC. So it's a way to create an entity. And that's where the real, I think, positive is. So you won't just have, in fact, I believe the SEC's position is if you say you intend to merge with X company and you only merge with X company, that's not okay. You have to have a second company that you also merge with because they don't want these firm deals starting. But I think as a practical matter, most companies, most people who sponsor SPACs have a pretty good idea of a limited universe of companies. So it's worth for your companies, the private companies, to talk to these people and see whether a merger makes sense. And it may make sense to merge 2 companies together. May make sense to do a pipe and raise capital at the same time. So I think, it's a great vehicle for private companies. And I don't think there's anything the SEC is going to do in terms of disclosure that's going to change that.
Steve, if you want to talk to that point in terms of how you guys approach it, like, is there a category of companies or specific targets that your SPACs have in mind, or what's that process of matching a SPAC with a company and doing the merge?
Yeah, I think that was well put. I would say we always want to have an idea of what's the vertical or what type of companies we're going after. And I do think there are SPAC sponsors that probably have not only an idea, but know who they're going to buy before they go public. That's specifically prohibited by the SEC, and you even rep on the front cover of your SPAC IPO prospectus that you've not identified a target. We are super cautious and careful about that because our business is doing multiple SPACs, not just doing a one-off where if you get a slap on the wrist when you do a one-off and maybe you don't do it again. But this is our business is doing these on a serialized basis. So as an example, this company that you've got up on the screen, that SPAC management team, Epiphany Technology, Art Coviello was the longtime CEO of RSA Security. One of the most respected guys in the cybersecurity industry. And so we've been focused primarily on cyber companies. But we certainly did not have any idea of who we were going to buy before we took the company public. But we did have a view that we're going to focus on cyber.
Any other questions for Steve or thoughts on this? I just want to put it in the larger frame. This is just a new source of growth capital. It's not really, doesn't represent an exit for any of our folks. And just as a reminder, Steve is a guru and investor in our fund, and therefore all of our portfolio companies. And he's already advised a couple of portfolio companies on how to think about this. So happy to kind of connect folks offline as well. And so very appreciative of this sort of inside baseball conversation. Any other thoughts on SPACs or questions folks have?
Chris.
Yeah.
Chris, this is Andrew Goodman from Nixon Peabody.
Andrew.
And Steve, I think great presentation. And I
Thank
just
you.
wanted to relay that a lot of our clients, from private equity to venture capital, are all interested in the SPAC space. We're fielding a lot of calls, and one is, in particular, is in the healthcare space. It's a venture fund that it would like to set up a SPAC, and they're thinking about it in terms of exactly like Steve presented, which is as an exit for some of their companies. Can't put it on the cover, but that's the way they're thinking about it. And I just wanted to add that this product has been around a long time. It was taboo, but even in talking with investment bankers over the last number of months, they are tremendously busy, and they think it's a great solution to the traditional IPO. And like Bob said, it's all about the due diligence of the management team. And Steve, it sounds like the teams you're working with have been really strong. So I just wanted to add, we're seeing a tremendous amount of demand. There's an education process. It's an alternative to the traditional IPO, and we're having every conversation with anyone really looking for capital. It's an alternative that they should be aware of.
Hey, Steve, can you talk a little bit about, and I'd love to kind of get other thoughts on this, and then I'm going to bring Jason Costi into the conversation. But one of the things that we've all experienced is the IPO window, quote unquote. So there's a time frame when, it looks like public markets are open to new offerings, whether or not that's a SPAC or a traditional IPO, and then that always seems to close. Why is that, and what's your outlook in terms of where we are on the process here, and how open is the SPAC/IPO market, and how long should we be thinking about it for?
Good question, Chris. So, markets are inherent, equity markets, I should say, are inherently volatile. And as I think everybody's heard, I really believe that markets fluctuate between greed and fear. And when there's more on the greed, people are more apt to put money into the riskiest assets, which are new issues. Because if you look at Google or Facebook or Coca-Cola or Procter and Gamble or Ford Motor Company, they've been public companies for many, many quarters, and people can evaluate their prospects much more easily. With a new issue, you got to take everything on faith with limited work. So there will, I think, always be times when people are focused on greed and want to buy those new issues, and when they're more focused on fear, there's going to be much less appetite for buying new issues. I would say since let's call it May of last year, we've been in a crazy bull market, especially for technology stocks, right? We saw stocks go down about a third in the March-April timeframe, and they've come roaring back over that time, such that especially high growth tech companies are now trading at record high valuations, which are sort of a head scratcher. And you look at companies which are great companies, whether it's Snowflake or ServiceNow or Bill.com, and they're trading not at 30, 40 times earnings. They're trading at 30, 40, 50 times forward revenues. And that's, I think the market's in a greed phase right now. We have definitely seen, I would say in the last 2 weeks, a little bit of a rotation, not so much out of greed, but into profit taking and a little bit of fear of higher interest rates are going to dent the growth of companies, and SPACs in particular. The NASDAQ is down 10 or 15%. I think SPACs are down 20 to 25% in the last 2 to 3 weeks. So we've certainly seen a rotation from more greed to less greed, and we may go through a period, and I don't know if it's going to be 2 weeks or 2 months, where we may be having the window may not be closed, but it's going to be not as wide open as it was even a month ago.
Because I think that.
May I add something? I think
Yeah, please, Bob. Yeah.
interest rates are the key. And that is all wrapped up as whether this new 1.9 trillion, which is really more than is necessary to serve needy people. There's a huge savings. The savings rate's higher than it's ever been. So people are afraid that the combination of the huge savings rate and the big new bill and an infrastructure bill is going to drive up inflation. And so the Fed, which has kept interest rates close to zero, is no longer a sure bet to keep interest rates that way. And that's the key, because when investors look at this, they're looking at what the risk-free rate is. So the Treasury not so long ago was 70 basis, 10-year Treasury was paying 70 basis points in yield. Today it's at 1.4, 1.5. So that's a huge increase. And if you can get a decent yield on your treasuries, say of 2 or 3%, that will be very difficult for technology stocks, especially because they don't pay dividends. So I think that's the key thing to look at, is what's going to happen with inflation and its implication for interest rates. And we really don't know that. We've never poured this amount of money in. Now, it's true there is some what's called productivity gap and production gap, but we're pouring in so much more than the gap has been that's why people are worried.
Great addition. And I think the other thing that should be clear is that all of these capital sources are interconnected. So whether or not we're talking about treasuries or SPACs or IPOs or growth capital generally. So great segue to maybe bring Jason Costi into the conversation. And another shout out to another guru who is very helpful to one of our portfolio companies on financing. So thank you, Jason, for helping, not yet announced, but instrumental in helping one of our portfolio companies. And as a reminder, also a former CFO of Casper and involved in PE as well. So Jason, what's your view from New York on growth capital and the stuff you've been doing?
Yeah, great talk, guys. Thanks so much for the insight. At a high level, I'd say, a lot of the trends, exactly as I think Bob was saying, come down to this market where there's a lot of capital that is attracted to the tech space, and people are just figuring out how to deploy it. And then when you get into the debt side, there's a new awareness around some of these tech companies, and I think that coupled with a greater awareness from the founders around the debt options, you're starting to see kind of all sorts of, structures arise, everything from revenue-based financing, which has been around for a while, but it's becoming a lot more attractive, and people are trying to stretch what contractual revenue looks like. Cash flow-based financing is harder to come by in the early stage, and then you have kind of newer structures coming from a new theme, which is software companies getting into the financing space through a bunch of different avenues. And some of those include like the Shopify type loans or the Amazon loans. But then you have all these new credit card companies that are trying to get into, to some degree, pushing out the payment terms for the market, and which is like a Brex or the like. And then you're also starting to see a lot more innovation happening around just the CFO suite around software. And one of the ways that these companies are trying to generate lead gen is through a financing mechanism, especially with the AP and really B2B payments. So I think there's a lot that's coming out. It's still really difficult for pre-institutional funding consumer goods companies to get the debt that they need to support working capital. More options than ever before, as I talked about with Shopify and Amazon and some of these kind of new software platforms or credit cards, but still pretty challenging. When you move into the institutional funding side, like an established VC coming in for a Series A, you have more traditional bank financing options. So that is a big unlock for businesses. I'd say that net, if people can find it, the cost could be on the surface expensive, but if these are high growing companies and they need the working capital to fuel their business, again, assuming it's not egregious or puts in some long duration, anywhere you could find it to some degree is a great option because it still is hard at the pre-institutional round.
Jason, can you also talk about D2C specifically and sort of some of the equity roll-ups and sort of the options around D2C companies that you're seeing at the later stage?
Yeah, I mean, you're seeing just kind of obviously everybody's reading what's going on with the Amazon marketplaces, and there is a new large funding round around those businesses kind of every week. It really kicked off with Thrasio, which Thrasio, the 2-second summary is they bought up a ton of fulfilled by Amazon businesses. So it's basically you outsource almost everything except for the deal acquisition process. And even that is very standardized. And they bought, I don't know if it's 50 or 100 very quickly, scaled it, and they've raised, I think now between debt and equity, over $1 billion. And most recently they were, acquired by Advent or invested in by Advent plus another debt round. So you're seeing that happen a lot. The school of thought is that with e-commerce taking up more and more share, the world is kind of bifurcated between Amazon at half of the, whatever you think the market size is, and then Shopify and everyone else on the other half. So people see that the Amazon platform is so powerful, and they're able to outsource everything that it's almost like not running a real business because it's a lot simpler. You are now starting to see more companies roll up the Shopify site and the other third-party marketplaces. It's a little bit more challenging to do that because those are real businesses, but there is still the desire to outsource large aspects of that. I'm a believer of the holding company. I don't think it's as straightforward as you buy a bunch of these and it's going to make money through the capital allocation and you're going to scale every cost. I think, when I was in private equity, you would buy, or even some of the large conglomerates that buy consumer packaged food, those led with like a distribution, and not arbitrage, but a distribution opportunity where they bought something that was, small and all overnight they could pump it through Walmart or Target, et cetera. I think here, when these companies are e-commerce first, the marketing line item, you're going to have a hard time, especially the variable cost side scaling. Where you do scale is certainly some of the cost side. You certainly scale, if done in a sophisticated way, the capital. So if you start to see one brand is, not seeing the efficiencies on the marketing side, you could start allocating it to other brands and kind of get a good return there. And I think, one of the biggest areas that you can scale is on the talent side, because, working with a lot of these DTC companies, they have a great product and the founders are incredible in certain aspects, whether it's, product development or marketing. But as we all know, it takes a lot to develop and build a business. And there's just a massive tax on these organizations to go out and build every single function. So what these holding companies or these conglomerations can actually provide and scale is the talent. And, you could eliminate some of those necessary functions that are hard for people to scale. And you can get them, to a very different place much more quickly. Or you're seeing some that face fatigue and don't, go on the trajectory of raising more capital, and they are just tired or want to sell out. And you have also now a potential off-ramp for some of these businesses that, may not have an off-ramp, where they are sitting today.
And I think that's a great segue. I mean, forgive the Canadian metaphor, but it feels like the canoe is tied to the dock right now. And there's, it's time to kind of check our assumptions coming out of COVID. And there are a lot of capital sources to kind of fuel growth. And I do think we're collectively going to be rewarded for stepping on the accelerator right now. But at the same time, using, again, that Canadian metaphor, the canoe may not always be tied to the dock. So having one foot in and one foot out, not a good thing. So, still mindful of having that 18 months of cash runway for all of our companies. And I guess the main point I'd love everyone to kind of take away from today is, think about hitting the accelerator a little harder, understanding the options on growth capital, And if you've got product market fit, if you've got confidence around product market fit and the unit economics are working, now's a great time to go scale. Because, to Bob's earlier point, I don't think we know what 2022 looks like, but the rest of the year in front of us, I think, looks pretty exciting. Any questions for Jason or Bob or Steve? Any other folks? I know we've talked to all of you pretty much individually and kind of had these conversations, but just want to kind of reinsert as a community. Like, you've got a lot of resources available to you. Kim Fennell is also on here, has been instrumental in working with, was Guru of the Year last year. I think this is our opportunity to actually thank him when all of us are here together with him. So Kim, thank you very much for all of your efforts last year. Just wrapping up here, not seeing any questions in the chat. Just know we're all here for you. Meryl and I, have been trying to do conversations with all of you individually. We'll do that again in the June timeframe, but we will have another Resilience, our 13th. So hard to believe we all been doing this for a year. The thing that we're going to talk about is really sort of second half planning and execution. So this idea of scaling up, and excited about that. And then if folks have ideas around, if you recall, Red Mask Ride, which was really sort of a community sourced effort to support our healthcare workers. If you feel a little bit tired, if you feel like 2020 was a long year, imagine being somebody like Dr. Rawlinson or these other folks that are working back-to-back shifts in the ICUs and dealing with everything that they were doing. So as we're starting to come out, I don't have a great idea on how to do this, but just a way we can, again, thank everyone for what they've done for all of us. Well, we've been hanging out on SignalWire, which I also want to give a shout out to, an amazing product that continues to scale, a portfolio company, and the SignalWire team's been really awesome helping us come together as well. So anyways, that was the main thing I wanted to leave you guys with on a Friday. As always, we're going to try to give you back the rest of your day. I want to thank again Steve and Dr. Rawlinson for their contributions, Jason Costi, Bob Posen, all gurus, all investors in these companies. So if you need something, pull the red handle, we'll make it happen for you. And have a great weekend, guys. Thanks again for the conversation, and stay safe. Don't forget, we still got a couple more months to get through here. So, look after your family too and your teams. Thanks, guys.
Thanks, everybody.
Thanks, everybody.